If you're waiting for a housing crash in 2024, sorry, it's not going to happen. And at the same time, if you're a home buyer out there thinking that home prices are going to shoot through the roof again, you're also likely to be very disappointed. The 2024 housing market might actually surprise you, as even though mortgage rates are going to improve and supply is going to pick up a little bit, it's likely to look very much like the housing market we just experienced in 2023. According to Redfin, 2023 was the least affordable home buying year in the last 11 years. But with mortgage rates dropping to the lowest level since August, housing affordability should improve, right? Well, the easy answer is yes, but you're not likely to see a significant improvement in housing affordability without seeing some sort of drop in home prices or an increase in overall wage growth. And I really think that's where the surprise is for most people, because people believe that because they can't do something, that no one else out there can do it either, and therefore something has to change. As a real estate agent for nearly 20 years, that's something I've been hearing in my career that entire time, that prices are too high, that they have to crash, things have to change, things have to pull back. And for the better part of my career, I've continued to see home prices climb and housing affordability continue to get worse. So even with US mortgage rates dropping to a 4-month low, home buyer sentiment is still sitting near record lows, with only 14% of consumers believing that right now is a good time to buy a house. And the primary reason that consumers are feeling that way is because of housing affordability, because it's so expensive to buy a home. Over the last couple of years, we've seen home prices appreciate nearly 40%. And during that same time, we've seen interest rates more than double, which if you took someone that was able to buy a $500,000 home at the beginning of the pandemic and get an interest rate somewhere around 3%, their mortgage payment with principal and interest would be somewhere around $2,108. But that same buyer buying that home today likely couldn't even afford to purchase it, because that $500,000 home is likely now somewhere around $700,000, and interest rates have increased to the highest level that we've seen in nearly 23 years to 8%. But since then, we've actually seen interest rates retrace a little bit, where we are today sitting around 7%. So if you took that same home at $700,000 and finance it at a 7% rate, you're looking at a payment of $4,657. That's over a $2,500 difference. In fact, it's more than 100% change in just over 2 years. But as we always discuss in other videos, it always comes back to supply and demand. And as much as people want to fight the premise of supply and demand, the reality is you're going to have a housing market that's similar to what we've seen over the last 12 months until you see an increase in the supply of homes. Now, with that said, there's a lot of people out there that believe you're going to see supply start to increase as mortgage rates come down, which we're going to talk about here in just a moment. But at the same time, you also have people that believe that mortgage rates are going to continue to go higher. So I want to take a minute and address that first. But before we do that, I'd like to take a minute and ask a favor. Do me a favor and hit that subscribe button if you find any value in my videos at all, and also subscribe to the channel to stay updated on everything real estate related. So for all of those people out there that believe that interest rates are going to continue to move higher, I want to take a minute here and talk about why we've already seen a decline of more than 1% from the peak in just over a month and a half. It's primarily because we're starting to see a slower economy, and that's exactly why the Fed paused in their second consecutive meeting, and why the Fed Fund futures are currently pricing in over a 50% chance of a rate cut as early as March of 2024. So at the moment, the likelihood of the Fed hiking rates any further is pretty much non-existent, and it's because they're finally starting to see what they were trying to accomplish from raising rates to start with, and that's a slowing economy. As we've talked about before, the Fed has a dual mandate. One is price stability and the other is full employment. And with that, we've seen job openings and private payrolls both come in less than expected, in addition to GDP forecasts being revised lower. So we're getting more and more data that shows the employment sector is starting to slow, on top of reports that show inflation is continuing to moderate, which is exactly what the Fed has been trying to accomplish for the better part of 2 years. And because of this, I think we've seen the peak in interest rates. Now, the only real caveat to that is if we started to see inflation numbers start to trickle back up, as well as the employment sector starting to gain a lot of strength, which I don't believe either is likely to happen, as there are more and more signs that show that the economy is likely headed for some sort of recession, which means the most likely case is that interest rates will continue to decline, which in turn will help housing affordability. But at the same time, I don't believe that interest rates will go low enough to really have a meaningful impact on overall housing affordability, where enough people can come into the market to push prices back up again. Now, that doesn't mean that prices can't go up. It just means that we're not going to see the type of growth that we saw over the last couple of years. The years of seeing 15, 20% appreciation in markets is gone. And that's primarily because there's just not enough able demand in markets to continue to push prices higher. But at the same time, I do believe there's enough demand coming into the market because of interest rates grinding lower that it adds additional stability to current prices, which in turn will keep them from going lower in most markets out there. Now with that, I want to go back to the idea that interest rates coming lower is going to add some inventory to the market, and that's in turn going to fix this inventory, this available supply of homes issue that we've been dealing with for the better part of 3 years. And the reason I say this is because I don't actually believe that interest rates moving lower is really going to add to the inventory out there. Now you might be watching this going,
Jeb, you're crazy. There are definitely going to be people selling their homes as interest rates move down because that makes things more affordable for them.
You know, for the better part of 2 years, I said that people were more or less locked into their properties, that they wouldn't sell their homes because of their current low rate. Why would they trade that current low rate for a higher rate and in turn pay more money for a property, causing their overall housing expenses to go up dramatically? And while I still believe that to be true, as interest rates come down, there are going to be some people that are on the fence, some people that have thought about selling their homes, just waiting for interest rates to come down a little bit, for affordability to improve just a little bit, so that payment shock of going from the 3% to the 5.5% or 6% isn't quite as bad as it would have been if they had sold and bought at, say, 7 or 8%. So yes, there will be more inventory coming to the market, more people putting their homes on the market as we start to see interest rates decline. But bear with me here and understand that even though those people are putting their homes on the market and selling one, they're not likely moving back in with their parents. They're not likely going to rent another home, and they're not likely to be homeless. They're going to put one on the market and take one off, which means that there's zero net gain in inventory to the market, which is exactly why I believe that house prices cannot crash. In order to see home prices move in a meaningful way, you need way more supply of homes, available inventory, than you have buyers willing to buy homes out there in the market. And so if a seller puts their home on the market and plans to buy another one, that home isn't really adding any additional inventory to the market. Yes, it's giving a buyer that would be a buyer an opportunity out there to maybe buy a home that they didn't have an option to buy before. But understand, because of this, it just keeps the housing market moving sideways in the worst case scenario. Now, at the same time, there are markets out there in the United States that have more supply of homes than they have willing buyers in those markets. And at the same time, a lot of those markets are the same markets that appreciated the most in 21 and 2022. So they saw the most growth, but they've also seen a lot of supply coming to the market at the same time. Yes, those markets are likely to pull back a little bit. You're likely to see a decline in some of those markets until you see demand equal the number of available homes out there. But I'm sitting here in Southern California, and our housing inventory is still sitting near record lows, just like a lot of the United States. So if you're a potential home buyer out there and you're waiting for some meaningful change in the housing market, for housing affordability to improve, or for you to be able to get in and get a steal on a property, I would say you're paying attention to the wrong information. Now, what I just went through is exactly opposite of what Redfin is predicting in 2024, as they believe 2024 is the year that homeowners are going to be able to catch a break, as they believe that new listings are going to rise and home prices are going to fall. So this is where I want to reach out to you as a viewer and get your thoughts on 2024. Is there any world in which we can see listings rise substantially, home prices fall, and housing affordability improve in any meaningful way? Do me a favor and let me know in the comments below. Now, earlier in the video, I mentioned a survey where consumers were interviewed and only 14% of them believed that it was a good time to buy a home. Now, this was a survey done by Fannie Mae, but in that same survey, there's a comment that I want to read from the chief economist of Fannie Mae that sums up 2024 in a really logical way. He says the combination of persistent affordability challenges and less rosy household finances remain the primary drivers of the low-level plateauing of housing sentiment. Even if mortgage rates decline over the next year, which we currently expect, it's unlikely to meaningfully affect affordability. The lack of housing inventory is likely to remain a challenge for some time, and home purchase sentiment may continue to be suppressed as a result. As our forecast indicates, we believe it will be a couple of years before home sales return to more normal pre-pandemic levels, which in summary means that mortgage rates are likely to improve, but housing inventory is likely to remain a problem, which in turn will keep home prices stabilized, resulting in a housing market very similar to the one that you've seen over the last couple of years.